Hi, this is Shane with The Rational Trader. It's Sunday morning, Super Bowl day here, February 3rd. And we're going to very quickly look at the weekly results for this first week of changing the approach. But really, I'm going to spend most of the time today on the analytical process and the steps I've taken to define it in a more rigorous way. And then I've done that analysis across all these four markets. So I'm going to walk through that so you can see sort of where we're at there. I'm getting close to have something that's, ultimately a well-defined process should be something you can automate. So we'd like to get to that point. I'm not quite sure if this is possible in this case, but I'll show you what I do. And then you can see why the codes are changing, and then for members, the spreadsheet with the codes has gone out with the normal weekly message with the new models. Okay, so for the week, so for Friday, I was up 5 ticks in oil, down 7 in the euro, max loss in gold, down 14. And then down 6 in the yen. So the net on the day was minus 170-ish. And that brings my return, or the return on the week, having trouble speaking. Oh dear. So the weekly amount is the same, is 131.25, and that's the same. The running total now we're going to keep as we enter this last phase here. Okay, so kind of a meh week, nothing spectacular going on here. Let's look at the process we're using to analyze the machine learning output, and then we're going to walk that through. We're going to use that through February, and then that'll give us some data to work with on how well we're doing there. Let's see, slideshow. So as a reminder now, what we're doing is we started off with looking for common behaviors over time. And this is the key thing that we're doing, is that there's enough randomness in the market that we want to eliminate the one-offs, because there's no sense of predictability to them, and instead look for behaviors in a market that we see repeat over time, or at least we see have occurred more than X number of times over time. And we did that by breaking the past X number of weeks into buckets. And our first attempt was to break it up into 4-week buckets, okay, and then analyze it. And that analysis comprised of 2 other elements. So bucket size was one of them, what I just described, 4-week buckets, as well as frequency. How often do you see a particular behavior show up? And then trade quality, which is what is the profitability of that behavior versus the number of trades you had to take of that behavior to achieve that result. So a trade that makes 50 ticks on 2 trades is as compared to a trade that makes 50 ticks on 10 trades, right? So obviously we'd like the former, right? The former is a higher quality trade. All right, now one of the problems that we see here is that the market does not behave in a linear way, and so this approach of a statically defined number of weeks per bucket and then X number of buckets is too rigid for how kind of the chaos of the markets. And so what I did is went off and I wrote the program to do the analysis in a way that lets me change all 3 of these elements and dial in to find the behaviors that are most beneficial, for this time period. Now, it's important to understand that typical system developers for trading systems, they're not doing what I'm doing here. Typically, they'll take this data, right here, like this 4 week, 4 times 6, this 24 weeks worth of data, and they'll find some set of rules to apply to it, and then present that as a system. Okay, and the problem there, of course, is that those rules are fit to the data, and there's nothing to suggest that those rules will continue to be fine in the future. They're specifically custom fit to that data. What I'm doing is quite a bit different, actually. So I've got a machine learning system that's trained the data that I've trained on data that is before this period of time. So in this case, if we go back 24 weeks, it's I built models for data through August 17th, and then I ran the predictions from that model on everything from 8/20 through last Friday to February 1st. Okay, so that's what, in terms of what's in the blue buckets here. These are predictions from a model that's never seen that data before. So there's no curve fitting going on here, and it's a big difference. And what we're trying to do is find the cases where we see the most amount of profit with the least amount of trades. Okay, and that's what this whole trade quality thing is about, and something in frequency, something we see it more than once. You'll see in a moment exactly how many times I'm looking for. All right, and we're going to do that, and we have to dig into that by altering this bucket size and altering the frequency requirement and altering the trade quality requirement, and then running a simulation with the results to see, well, what do you actually get? Okay, the output of this is a risk factor, which is basically how many times am I taking a maximum loss day compared to how many days are in the data set. Okay, and then so let's go through the process here for CL, and then we'll take a look briefly at the other three. I've got some conclusions about the other three that I want to share as well. Where's my spreadsheet? I don't have it up. All right, so this is the sheet that goes out to members now, and this has the results of the analytical process that I'm about to describe for each of these markets. In oil, there was no obvious break between like a conservative or aggressive setup. So this is basically just conservative. Risk factor is 11.86. I want that 20% or less. All right, this is how often am I going to take a max loss day? These are the behaviors, long and short, and then this is the actual output of the simulation run for this set of behaviors. Okay, so what that means is that if we go back to this chart here, I've done some analysis that said use these behaviors, okay? But then we actually go back and run a simulation using those behaviors for this period of time to see, well, what do you actually get? It's not, and the reason we do that is I may show, let's say, like I show a like a really high quality behavior or trade setup in the first two buckets, but then it sucks the rest of the time. And so it might float to the top of the list as the trade you're really interested in, but when you actually run it across a longer period of time, a more statistically valid period of time, you discover that, well, it was only it only worked well some of the time. Okay, so with that in mind, if we look at oil, this is the final result, but the process is sort of a series of analyses, and it's this cell here that shows the parameters that is what's most, I think, tells the tale the best. What this says is 28 days is the bucket size. The trade quality is at least 5, and I want to see it at least 3 times. Okay, so since we're using, and the number of buckets is 5, okay, that's this right here. So what that means is that more than 50% of the buckets, 3 buckets out of 5, showed these codes, these behaviors, as they showed up as high quality trades, or trades that met the quality parameter of 5 or better. All right, and that gives you a number, right? This number is 350. That's ticks, and it gives you a couple of other numbers that are important. One is the overall trade quality, which is E/R, efficiency ratio, 5.22 in this case, as well as the risk factor. So 4.24 is extremely low. What that means is that 4.25 days out of, it means it's the percentage of time that you'll take a max loss day. So there were 5 actually. You can do the math yourself. It's max loss days equals 5, which is right here, and the total number of days was 118 in the data set. All right. Trades per day, 0.57. So basically a trade every other day is what that says. All right, so this is the first cut. All right, so the first slice is 28 days per bucket, trade quality of 5, and I want to see it at least 3 times. Okay, so and that gives us this sort of starting point of these codes. All right. I then take those codes and actually run them, and that, I get that's where this number comes from, or this row comes from, profit of 350. So then the set below, there's 2 sets here, right? So there's a set here. All right, let's make this some color, and then there's a set here. All right, and we'll make this green. So the yellow is the entire 6-month period, or 24-week period. It turns out to be less than 6 months because you've got holidays and things like that. So that's why there's only 5 buckets instead of 6. But this one here is the same set of codes run just for the last 4 weeks. Okay, and what I'm doing here is I want to see, well, is there a dramatic difference? If things were linear, you would take this 350 number, divide it by 6 or 5, and then you'd expect this profit number to be similar. Now, there's a couple of caveats. The first is that because the model is getting older and older relative to the data, there's some expectation that it will degrade over time. So I would not expect this to be perfectly linear, even if the markets were not chaotic. But the other point is that we want to make sure that, let me go back to we want to make sure that there hasn't been some shift hasn't occurred in recent times. All right, so that it could be that everything's showing up roses here in the first 4 buckets, but in the last 2, it's all there's been some shift in the market. It's all gone bad, and so we want to keep an eye on that. So what each one of these outputs shows is the full data set and then the last 4 weeks. All right, to give us a sense for, okay, well, if I ran these codes based upon an analysis of the last 6 months, how would it have actually worked in the last 4 weeks? Okay, this is going to come up later in the currencies where there appears to be a sea change underway. Okay, so here we went 2853 and got this starting number, this baseline 350. All right, then I went, okay, well, give me trades in the same buckets, but that are higher quality, but I don't require to see them as often. So a 7 is the trade quality value, but the frequency is less. In other words, give me ones that are better, but maybe don't show up as often in the same buckets. All right, and that gives me another set of codes. Okay, and a higher profit number. And in this particular case, you would, given these parameters, you would expect this to be a superset of the initial run, since they're both the same bucket size. Okay, so we because we are requiring a lower frequency number. Everything that's in the first set should be in the second as well, since well, that's not completely true. If I've got trades that are showing up twice but have say a quality of 6, they won't show up here, but they will show up in the first one if their frequency is, if they show up 3 times. Okay, so anyway, we get a group here, and okay, that looks pretty interesting. Risk factor is 13.56, so quite a bit higher. Now, so if you think about that for a second, what that means is I'm requiring that I see it less often. All right, so there's more opportunities for that trade to show up in another bucket where it didn't work out quite so well. So if we go, just to try to help you understand that, maybe I see these particular behaviors in these 2 buckets. All right, it doesn't mean that behavior doesn't show up in the other buckets. It just means it didn't show up as a high quality trade in those other buckets. Okay, and this is the key thing to understand. So I'm looking for a high quality trade. I require that I only see it twice out of my 5 buckets. But what about the other buckets? What about the other time frames? It may not have shown up at all. Okay, or maybe that trade did show up, but didn't do well. And that's what this helps us understand here, is that the trades that have a higher quality do show up, and the total ends up making quite a bit more, 200 ticks more across the same time period. But you end up taking quite a bit more trades, and it doesn't always work out, right? Because 16 days you're taking a max loss as opposed to 5. Okay. And so our goal here is to pick out the ones that have the highest profitability with the least amount of risk. All right, based upon the machine learning prediction. In this particular case, these parameters yield this profit on that risk, and then for just the last 4 weeks, it's that profit on that risk. Okay, but what you see highlighted in red here is me noticing that in the last 4 weeks, the quality of the trades has been low. So this ER is 3.04. Here it's almost half that. Okay. This says, well, look, show me even higher quality trades. 28.82. All right. And so what's interesting here is that to compare these two, this is 28.72, means the bucket sizes are 28 days. The trade quality is at least 7. And I need to see it at least 2 times. All right. This says, well, 7's not good enough. It has to be at least 8. And so here I get a profit of 506. All right. My efficiency ratio is really good at 5.01. All right. And then the risk factors drop through the floor, 3% of the time you're going to take a max loss day is what that says. Right, and then also for the last 4 weeks, that's a decent number with a high quality overall system ratio, efficiency ratio. Okay. And then what I'm doing as I'm walking through this is I'm looking at these codes and these and these, all right, and looking for the sort of the intersection between them to find the balance. What is the optimal balance between profit versus risk? Okay. So then at this point, I've kind of exhausted what I can do with buckets that are 28 that include 28 days. These are calendar days, by the way. So it's 4 weeks. So now I'm at 21. I dropped to 21. So show me, smaller buckets, high quality, 8, and I want to see it at least 3 times. And you can see there's only 2 codes there. All right. But what this does for me is it tells me, all right, pay more attention to this code, these codes. All right. And so in this case, you go back and you look, and 122 has not been, this behavior has not shown up as a long in these previous analysis runs. And so, okay, that becomes a candidate to add to see what do you ultimately get, all right? And then, as it turns out, this was the only 21 bucket run that yielded anything useful. So I don't copy and paste everything. There's too many. So then let's take a look at it at 14 buckets, trade quality of 7, but I have to see it at least 4 times. So you can see what's happening is as we make the buckets smaller, there are more buckets in total. Here there's 11. And I got to say, okay, I want to see this trade at this quality level at least 4 times out of 11 buckets in order for it to show up. And so we get a couple more here, 201 and 293. I bolded the ones that are new, 201 and 293. And then here we're dropping down to 1 week, 7 days, a lower ER, a lower quality ratio of 4, but I got to see it a lot of times, 10 times out of 23, not quite 50%, right? And I did this a bunch of times. The interesting one that showed up was 264 short, okay? So I take all of that, and then I run some different combinations of it to yield the final, which is what this is, all right? So you start putting together, the good behaviors from smaller bucket sizes but higher frequency, all right, all the way up the chain. And when you put them all together, and you end up with something that looks like this: 822 on a risk factor of 11.86, all right, and an ER of 4.15. Okay, so that's very good. We want risk factor of less than 20. So this is way less than that. And then the way to think about efficiency ratio is, well, how many ticks did I make per trade is the way to think about that. And so you want this number to be as high as you can, and yet still have enough trades to make it worthwhile. So I can make this number really high, but you'll take one trade a month, okay? Just by picking only the super highest best, all right? And we have to find a balance between just taking every behavior that might be positive. So it's not enough that it just didn't take a loss, all right? It has to be. That would be one end of the spectrum. And the other end of the spectrum would be it's super high quality but it doesn't show up as often. All right. And so you could go a long time without taking any trades at all in that case. So we want to find the spot in between. All right. And that's what the intent of this process is to find the behaviors in this market that yield the best result on the least amount of trades to give us the most amount of profit with the least amount of cost. All right, so we're trying to minimize commission cost. Okay, so trades per day is 1.68, and then on the last 4 weeks, it shows 61 on a risk factor of 20. So four of the last should be 20 days. See, 4 of the last 20 days were max loss days if I used this set of codes. All right, so now that looks reasonable to me, and so I will put this in as the codes I'm going to use for oil for February. Now, very quick, we're almost done here. Very quickly, when we look at gold, I see a couple to think about. One is it's higher risk. All right, so that's what this is here. Whoops, that's not what I wanted to do. And then one is lower risk. All right, and the differences are shown. It's kind of color coded. There's this blue or purple color, and then there's this orange color. So this output here belongs to this lower risk factor, and this output here belongs to the higher risk one. And you can see the differences. The lower risk gives us 463 on 14.41, right? And in the last 4 weeks, 42 versus on a risk factor of 15. The higher risk one, the profit is higher in both cases. It's double the last 4 weeks. On a risk factor of 17.8. The thing to notice here in gold is this ER. The overall system ratio that's really low. Okay, I wanted at least 2. This is the best I could do. And what this suggests to me is that there's not enough movement in the market to make it worthwhile, or the chart is not fast enough. So I believe gold needs a faster chart. So I'll be working on that. But in the meantime, I'll be running with this lower risk set of codes here. The currencies are interesting. So let's look at the yen. So the yen is the same thing. I found sort of 2 sets to work with, and part of the reason I went looking for 2 different sets is because of what you see here in the more aggressive, so risk factor of 14.41, which is still well below 20. Both of these have to be considered conservative. What I show here is, a 451 profit, but in the last 4 weeks, only 13. And actually, in this more conservative view, 383 profit, but the last 4 weeks has been minus 19. And this suggests to me that this market is undergoing a change, all right, because the profit that's shown in the simulation run includes the last 4 weeks. And so what this means is that it's 383, even though the last 4 weeks has been a loss of 19 ticks. And so because of that, I'm a little concerned about the currency market, and so I'm more inclined to go conservative because of that until that change fleshes out, or I understand better sort of why we're seeing that. I am able to sort of flip it and go, well, just show me a shorter period of time that's more recent. But we end up not finding commonality when you do that. You need enough time to have buckets to analyze to find behaviors that show up with some level of frequency. If I reduce that down to say 3 months or 2 months, just the last 3 months or 2 months, it's much harder to find commonality. And in fact, that's the experiment we ran in January where things did not work out so well. So in December, in oil, we were using a 6-month analysis, and then in January we're using 3. And the difference between the results in December and January were profound. That was discussed in a week or two back video. All right, so we want to stay with using more data across a longer period of time, and then just pay attention to this. This has me concerned, and so because of that, I'm going to go more conservative, which means I'll be using this set of codes for the yen. In the euro, it's not quite as bad. If you look at there's a more aggressive view here. This is actually a better split, I think, between more aggressive and conservative. This is 21.19. All right, so that's a little bit more than 20%, which is kind of my threshold. But it's nicely profitable, but not the last 4 weeks. Okay, and so this suggests to me that there's a change going on in this market, and because of that, I want to get more conservative. And so that's sort of why I went back to formally define this category of risk factor. And what that yields is, it's quite a bit less, 587 versus 728. But this risk factor is important because it means that it's the probability that you're going to get taken out for the day. All right, and it's not. You don't want to think of it in a linear way. It's not like this is now twice as probable. It's more than that, just because of the way that the randomness works. All right. So if I have a 6-sided die, this is a good example here because this is doubled. If I have a 6-sided die and I roll it 100 times, and if every time it comes up with a particular number, let's say 1, then that's a max loss day. If I just do that, it's an interesting experiment to do because you can see, well, how many times in a row do I get the number 1 showing up, right? And because what we want to do is we need to balance it out. We don't want to get taken out of the market, because that means we're no longer able to take advantage of any opportunity in that market. And if we get too many in a row, we're done for the week, right? So two losses in a day and you're done, and then 2 max loss days in a row without a previous profit, and you're done for the week, all right? So if you take that die, and you roll it, and if it shows up 1, then that's a max loss day. You can just do that. You can just run that simulation in any spreadsheet using random 6, and then look at how often do I see a series of 1s in a row. As you apply that to our trading in a live environment, that would mean how many days did I take a max loss? All right. So if you then think about, well, if what the difference between these two risk factors is that this is twice as many, right? It's 20% of the time instead of 10% of the time. All right, so now take my 6-sided die and go, if 1s or 2s show up, that's a max loss day, and now roll it 100 times or 1,000 times. And look, and what you'll find is that there's a lot of sequences where you can get 1s and 2s in a row. And this is what we're trying to avoid. We want to stay in the market so that we can take advantage of the opportunity that the market presents. Okay, so given that I'm seeing this in the euro, a nice profit for the last 6 weeks, but nothing for the last 4 weeks, this suggests to me that that market's undergoing a change, and so I want to be more conservative. I'll use these codes, and then next month when I run the analysis again, we'll see, how much have things changed. Okay. All right, so that's it for today. This will go out to members, and then I'll highlight to all of you what exact codes I'm using in my production, my trading. I'm trading. These are all live accounts. They're all trading real money accounts. And then the other thing I'm going to do here is I want to walk through this same analytical process for the NASDAQ and the ES. So I'll be doing that over the next few days probably. So members look for that. If you're trading those, you might glean some valuable information. I want to do that. I'm not trading those markets right now, but I want to do that just as a way of I want to apply the process to another market and see if anything pops out as something that needs to be adjusted or changed. Okay. And then the other thing, again, what I talked about earlier, I think that gold needs to be moved to a faster chart. So basically, we need more. If there's not as much movement in the market, then you need more signals to catch the smaller moves. That's a lot of work to do, so that'll take some time to effect, and then there's no guarantee it'll actually yield a positive result. So it's something I'm very careful about choosing to do that. All right, so I'll be working on that this week. So probably by the end of the week we'll have something to look at. And can decide what to do. Further things on the horizon, I'd like to take what we're doing here and apply it to the 6E during the overnight session. So that's on my list of things to consider. I like the rigor in the process that we have, and so while we're basically running, a new experiment here in February. It takes the learning from December and the learning from January, and then adds some refinement. And now let's see what our end result is. But now we've got to actually live that 4 weeks to see what it is. Or it'll be 5 here because we've got a week under our belt already. All right, so that is it for this weekly review, and I will see you on Monday. Members, look for the message for the models, the current models being up, as well as this spreadsheet. Take care.